HaaS is referencing hardware as a service. And we view hardware as a service business models as key to allowing customers to adopt technology without taking on the large upfront costs and operating risks associated with trying something new. So for companies providing the hardware as a service, and the investors in those companies, they receive recurring revenue, cash flow visibility, stability, all of the things that, special ops likes from a downside protection thesis. And then oftentimes we at S2G pair these types of HaaS financing facilities with potential upside levers as well, such that if the model takes off, we can benefit from that growth as well. So all in all, these models align incentives across the customer and the hardware owner such that the customer is receiving the best performing product and associated service, which over the long run hopefully results in increased efficiency and less waste for everyone involved. So I think we're all kind of well aware with what's happened in the equity markets over the past few years with kind of a shift from abundance to scarcity. And a lot of capital has gone to chasing fewer, larger deals, leaving many of the growth stage companies that we see at the missing middle here at S2G without sufficient funding. So we see these companies that have assets, particularly in the form of contracts or leases, paired with hard assets as perfect partners for special ops and the financing facilities that we offer. If these businesses can prove that their assets and associated contracts are stable, they should ultimately deserve a lower cost of capital than what they can get through the equity markets today. And our strategy allows for that. As it relates to equipment finance, we traditionally see them rely on residual value of hardware. We at S2G underwrite the durability of cash flows via leases and offtake agreements as the primary security and residual value of hardware secondarily. Typically, we see traditional venture debt providers invest in all types of early stage businesses, and they are really focused on equity on balance sheet rather than assets in the form of contracts or future cash flows. Also importantly, our approach is highly flexible. So we're tailoring every facility via structure, tenor, cost of capital to match each company's stage, their customer risk, and ultimately risk return profile. So we don't just have a term sheet off the shelf that we're handing a company and saying, take it or leave it. Really work with them to tailor something from the ground up. So in short, we prioritize companies with long-term contracts or leases, scalable pipelines, typically hardware agnostic business models that enable more flexibility, and credit-worthy customers and robust O&M integration.